Are you wondering how to know if a company listed on the stock market, new or old, is actually worth investing in? Let's break it down for you in simple terms. Start with the business itself. What does the company do? Is it in a growing industry like green energy or digital services? Look for unique products, a trusted brand, or a cost advantage. These give a company an edge. Next, check if the company is making money and growing steadily. Key signs of financial strength: revenue is rising year after year. Profits are consistent. Return on equity is more than 15%. Low debt and strong cash flow. Ask, can the company grow more in the future? If it's investing in research, expanding to new markets, or launching new products, that's a good sign. Also look at how the stock is priced. Compare its price to earnings or PE ratio with other similar companies. Is it paying regular dividends? That shows confidence. Strong companies follow clean practices. They share honest updates, have independent board members, and clean audit records. For IPOs, check why they're raising money. If it's for growth, good. If it's just to repay debt or let old owners exit, think twice. Also look for big institutional investors. They do deep research. Keep an eye on recent updates. Mergers, earnings, or leadership changes all tell you what the company is planning next. Don't worry, you don't have to do it all manually. Use websites like screener.in, Moneycontrol, and ticker tape to check financials and reports easily. And finally, beware of red flags. Promoters pledging their shares. Too much debt, no profit growth. Sudden exits of CFO or auditors. These might mean trouble ahead. So remember, a good company has solid business, clean financials, room to grow, and nothing shady going on. Do your homework before you invest, and you'll thank yourself later.